So this video is a bit different. It's a video recorded a number of weeks ago, but it's really useful. It's about a deal that came across my table and it goes into a lot of numbers and analysis. It's very advanced. So I'd recommend taking out a paper and pen. And just as a heads up, my handwriting in here is terrible, so please don't judge me. But there's a lot of valuable content that I'm hoping that you find enjoyable. So watch along. Okay, so in this video, I thought I'd change up a bit and I wanted to go through a deal that came to me a few days ago. Now, this was an opportunity that was shared with me through the network of investors as well as sources that come to us. Now, this particular deal, if I go through it, was in London, in an up and coming area near a number of international embassies. So it's a strong area for more the wealthy individuals. The structure of the deal wasn't an outright purchase. So let's give you the details. So it was effectively like a purchase lease option. So PLO, or a right to buy, or rent to buy, should I say. So rent to buy opportunity. The purchase price was for £9 million. And the value at the time that they estimated, the value was 8.7 million to around 9.2 million. And then the deposit was 150,000. So a very low deposit indeed, compared to putting down 25% of that, which would be a couple of million or just shy of that. And then the term, i.e. the time between agreeing to rent it and then having the option to buy it, so the term was 3 years. And now, excuse me if my handwriting is not the greatest. And what they considered the opportunity was an expected value after 3 years. So the opportunity after 3 years was they thought the value would increase. So go from the 8.7 to 9.2 to they thought around 10 to 10.5 million. So roughly a 1 to 1.5 increase. So capital appreciation of 1 to 1.5 million. So on the face of it, many investors may think, oh, really good opportunity, but what's the catch? And one of the key risks to be aware of that gets you thinking whether this is an opportunity is, what is the rent? So typically when you're doing a PLO or rent to buy, it's about the terms. It's getting a good price, but what's the terms? So you want more time to allow for the equity to be built up. Now, as you can see from this, the equity, based upon what they thought it would go up by, and speaking to local agents, was to increase by 1 to 1.5 million. So what some may say a mega deal. But no matter how small, big, or large the deal is, you also have to always look at the numbers and look at the intricacies of it. So for this particular deal, the rent that had to be paid was £20,000 a month. So it was £20,000 per month, which effectively is 240,000 per year. So just to clarify, that's £240,000 per year. For full transparency, not always the type of deal that comes across my table. Usually it's between much lower than that, but this was what they would consider a mega deal. And sometimes mega deals is what propels you to a higher level. But you also always have to be confident in your due diligence, your numbers, the steps you're taking at every stage you're doing at present. It's always building you up for the next stage. For this particular deal, I use the same kind of analysis that I adopt. And for this, before I even get into putting detailed calculations that take me a number of hours, I always look at it from a quick sense check. And the quick sense check was, okay, you're paying £20,000 per rent per month, brilliant, or okay, but how does that relate to what you can rent it for? A rent of around £1,000 per night as a SA. So if you watch my first Dwayne's Development Diary, you'll see that I went into a lot of detail of what a SA is, or serviced accommodation is. So they're looking at £1,000 per night, and over 1 month, let's roughly calculate that as 30,000. So at a very basic level, before you even factor any bills, costs and ongoing management, you're looking at a deal that is 20,000 per month rent, cost, and then you're looking at 30,000 takings, i.e. revenue, and that's 100% occupancy. 100% occupancy. So around £10,000 gross profit. But if you've never done this, run a serviced accommodation, there's a number of things. With serviced accommodation, you're given a fully inclusive service, and that means covering bills, that means covering cleaning, that means covering maintenance that might happen. So that can all add up. And also, you should never be factoring in that any property will run at 100%. The couple that I have run at around 70 to 80% occupancy, sometimes goes down to 60%, and then as high as 95. But I would never push or encourage you to use 100% occupancy. So if you look at the whole hotel industry, they go off roughly around 70 to 75%. But you always want to use conservative numbers, so we'll go with 70%. At 70% occupancy, you're making around £20,000 per month. So only £1,000 gross profit. So gross profit of £1,000 per month before bills, etc. So first risk to factor in is the rent. So this is risk 1. Risk number 2 is actually the capital growth rate. The risk 2 is factoring in capital appreciation. So if you remember, the capital appreciation would go from 9 million all the way up to roughly 10 to 10.5 million after 3 years. Now, my view is very different to that, and that's using based upon public data on growth rates from what Rightmove share, Zoopla share, and London, out of all the areas in the UK, has been the most impacted in terms of capital growth. So London has been growing at an average of around 2.5% per year. So around 2.5% year on year, last 5 years. And based upon what they were assuming is around 5 to 6%. And they were using a 5 to 6% inflation. But capital appreciation based upon the last 5 years, and we know the history doesn't necessarily mean it's going to happen in the future. Things can always change, but we have to use the data that we have around us, and that's 2.5%. Now, risk number 2 is also, and it's also linked to capital appreciation, at those higher end values, i.e. the plus £1 million properties or etc. in the London area, you're looking at a different type of buyer. You're going to look at a smaller market. It's not the mass market that will be able to afford that. It's a smaller market. And based upon the type of buyer for this was going to be international buyers. Now, there's so many things changing in law that mean international buyers are being impacted. There's more higher tax rates. There's challenges in terms of know your customer, anti-money laundering. So not only have you got a tight market, but there's more regulation going around that, which could have impact on supply and demand, i.e. the demand could lower, which impacts upon what the capital appreciation could go up. So that's another thing to factor in. So here's what I consider the true analysis on this deal. So the first thing I always look at when you look at these type of deals is what's the present value factor, i.e. what's the future value of that deal or capital appreciation, but brought back to today's money. So we call it present value factor. And this may be a bit more complex for some. So with the present value factor, it factors in what's your rate. So the rate we should be comparing any investment is if you stick it into the stock market, then your typical rate would be around 6% on an index fund. So you're looking at around a 6% rate to apply. It looks at the period, and the period is 3 years period. And then it also looks at the value that you think you're going to get. So in this scenario, we're using a value of 1 million to 1.5 million. So when you adopt the present value factor, the actual value goes from 1 million to 1.5 million down to its true value of around 816k to 1.2 million. So the first scenario we're calculating would then be saying we're making between 1.6k to 1.2 million minus our gross rent that we're paying. So let's just assume we made 70% before all costs. Then our gross rent of that 3-year period would be 720k. So you'll say scenario 1, you're netting roughly 100k to 500k. So for some that might be great, but also you factor in this is before running costs as run as an SA. So remember cleaning, utilities, bills, maintenance, etc. Now then we've got variables in that. So you remember we've got a variable around the capital appreciation rate. We've also got variables about what's the occupancy rate that we can achieve for this property. Okay, so that's scenario 1. Now scenario 2 is actually looking at the occupancy rate. So if you remember, we were looking at 70%, but with COVID, with changes in how we work and how we operate, there's also a risk that occupancy could be much lower than that. It could actually be running at 50%, lower than that, 30%. So if we then went with an even more conservative approach to occupancy, let's look at 50%. So we use 50% occupancy. And that would then mean that actually, rather than us making 21,000 gross rate, it would be 15,000. So it'd be 15,000 gross rent or revenue. But remember, we're paying £20,000 in rent per month, which would then mean a loss of minus 5k. So the actual cost of the property per month before cleaning and utilities, etc., would actually be different to that. It would actually be one where we're looking at a cost of around £25,000 per month, which per year would be a loss of 300k per annum, which over 3 years would be 900k. Using the estimate of making a capital appreciation based on the present value of 816k to 1.2 million minus 900,000, we're actually then looking at a very different view of the world. We're looking at a view of the world that says you'd be making a loss 84k to a profit of around 300k. So that's scenario 2. And scenario 3 is one where rather than just looking at occupancy rate, we then also look at a low occupancy rate of 50%, and also the year-on-year capital appreciation being 2.5%. So we're looking at occupancy rate equals 50%, and we're looking at 2.5% year on year. So based upon a 2.5% year-on-year capital appreciation, rather than the value of the property going from 900,000 to the 10 million to 10.5 million, before we even factor in the value factor, it would only go up from 9 million to 9.7 million, which is £700,000. And then that 50% occupancy, we're making a loss of 900,000, or we're paying a cost per over the 3 year of 900,000. So you're actually making a loss of around 200,000 before, and that's before doing present value factor. That's before factoring in your cleaning and bills and costs and maintenance. It's a loss of 200,000. So just to reconfirm, scenario 1, you'll make between 100 to 500,000 pounds. Scenario 2, between a loss of 84k to a profit of around 300k. And actually, before any present value factor and other costs, scenario 3 is a loss of 200,000 pounds. So is it a good deal or not a good deal? Question to you. For me, no, and I turn that down. But for you, maybe it is. Maybe you've got a different view on the world. Maybe you think, actually, I've missed something. Let me know in the comments, raise it. I'm always there to learn. But for me personally, I turn this down. Maybe it can work for someone else. Just doing a quick analysis, there's a lot of variables and a lot of risk, and there's a lot of assumptions around around the growth rate, and not a true analysis of what it takes to run a service accommodation and the costs involved. So the key lessons is to know your numbers, is to be diligent. Although something on the surface level can look like a good deal, do a quick analysis and see whether it still stacks up. Today's market can be very different in 3 years, as we've seen. Who could have predicted that black swan event that happened with COVID? No one could. So always, especially with purchase lease options, especially with a deal that's down the line, especially when you're buying something based upon a capital appreciation, you want to make sure you mitigate your risk. It's all about how do you preserve your wealth and grow it at the same time. I remember one of the key lessons I always learned was preserve your wealth and your capital, because that keeps you in the game, and then look for home runs where you can still mitigate your risk but win very well as well. So that's the same approach. Know your numbers, preserve your capital, and that means you can stay in the game much longer and look to make a legacy in the future.